Welcome to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. I'm Erik Ainge, host of The Erik Ainge Show. We got creative with the name on that one. We're here for an inside look at how this team coaches their clients to organize their investments, their retirement, and their affairs. I'm going to ask the questions. I'm going to quarterback this deal. And if you're sitting here with us listening, will make you a much more informed investor, hopefully a much wealthier investor as well. If what you learn makes sense, and if you ask them nicely, they can have a chat with you and understand your situation and see if working together might be a good fit. Here's the team here. Megan, former first grade teacher at Christian Academy in Knoxville and has a master's degree in curriculum and instruction. Jerry, Megan's dad, he was on the professional staff of Price Waterhouse, was a vice president at Merrill Lynch, and is a CFP with 43 years of experience. Guys, it's good with me. Megan, Jerry, it's 1st and 10. The ball's on the 20. We got 3 timeouts. Where are we going from here?
Thanks, Erik. And we are so excited that we have actually tricked you into helping educate anyone brave enough to join us. And if you have no idea who in the world Erik Ainge is, we'll just say he was the quarterback, or Tennessee, for 4 years under Philip Fulmer. Surely know who that is. He went on to play for the New York Jets, and he's on weekdays from 9 to 12 on 99.1 The Sports Animal, so you can get more of him over there. I feel like we should run through a T before we start, though. I mean, is that possible?
At least slap the sign, right?
Right.
I will give my all for Tennessee Wealth Management today.
Correct. So, Erik, the fact you're on the radio for about 15 hours every week is actually pretty amazing to me. That sounds like a full-time job. So do you have someone help you to organize everything you talk about on the air?
Yeah. I have my wife, Susan, and my work wife, Brian Rice. It can be a struggle, though. Things change day to day, and most of the time, different seasons, they overlap one another. We're not just talking about one sport.
Well, we really appreciate you mentally switching gears to talk about a completely different subject. And hopefully, we have some of your radio show listeners tuning in to see what you're up to with us.
When we first got to know each other, guys, I realized pretty quickly that you all were explaining things that I had never heard before. It made sense, and I understood, and I thought my listeners ought to hear that as well. Everyone ought to hear that. And this is certainly not my area of expertise. I'm a, Jack Right Zip, Act 4 Cobra, Dover, F Shoot Hob kind of guy, on two. But, giving not only that, but getting the advice that I'm going to give someone, that's to be listening and open-minded, because you will learn things from these people right here ready to help you.
We appreciate and super glad you're here, Erik, and really for no other reason, you may need to blow the whistle in case Megan and I perhaps get in an altercation.
Which is totally possible.
It is possible. That's a father-daughter thing. And basically, here's a kind of a random sports question for you, Erik.
All right, shoot.
So on the show, you talk a lot about coaches and various teams, and what is the single biggest reason why a coach is going to get himself fired?
Oh, that's a good question. A variety of reasons, but the single biggest reason is always going to be performance, right? Your job is to win or lose. You are what your record says you are. You can have the best game plan, best coaching staff, attitude's important, all that, the school, all that stuff matters. But when it's all said and done, if you have a bad track record over a long period of time, you're probably going to be looking for a new job at some point.
And as adults, a lot of us have transitioned from having an athletic coach when we were younger to now, and what we'll refer to as a financial coach, okay? The reason we bring this up is because it's pretty uncommon for someone to ever fire their financial coach. We see athletic coaches getting replaced pretty, frequently if they don't have a great track record, but really not the case with financial coaches.
Well, you'd know more about what investors do with their own advisors, but, if you're going to keep the fans happy in the SEC, the university better be willing to make some changes to the coaching staff. Even if changing coaches doesn't help, it looks like they're doing something for the team to do better.
That's very true, but some people may have had the same doctor, same dentist their entire life. And the reason they don't fire their financial coach is basically it requires some effort. Maybe they don't realize the coach should even be fired, or they don't have another option, that would actually make them happy. So, in fact, if you ask ChatGPT, it's going to tell you that less than half of all investors who actually know what their 5-year track record is, and it's probably more in a range of 20 to 35% that know, okay? So even if they do know their own track record, they don't know what to compare it to.
Well, and I'm guilty of that because I couldn't tell you what I've actually made over the last 5 years. And until I met you all, Jerry, Megan, and everything that y'all are doing, started looking at that, I wouldn't have even known what to compare it to, even if I did know, versus the other options that are out there.
That's exactly right, Eric. And these radio shows and our podcasts allow us to discuss a lot of things that advisors either, don't know or they're just not going to tell you. So let's start off with something a financial advisor will never, ever, ever tell you, okay? But we're going to tell you. Here's how much our clients have improved their financial future over the last year. So during the first 9 months of 2025, the 210 accounts we were managing on September 30th, 2025, had an average net rate of return of 33.2% for those 9 months. Now, to put that into perspective, 33.2% is over 3.5 times the return of Dow Jones Industrial Average during that same period. And to be clear, that was 33.2% increase in actual value in just 9 months, not an annualized rate of return for the first part of the year.
Okay, time out. So my first comment that I didn't even know what my own performance has been for the first 9 months of 2025, I know it's nowhere close to 33%. All right, if you're a listener to the Erik Ainge Show, you hear me giving my opinions all the time. We should have called this play, shouldn't have called that play, should have not thrown the ball in the end zone, telling you who I think is going to win. But I'm not here to offer my opinion on any of this. I guess what I'm here for, guys, first off, y'all are awesome and we're friends. That's part of it. Also, just telling people, suggesting, hoping that you listen to what's being explained here. And if nothing else, you're going to have that other options for whatever you've been doing for your investments to bring attention to it.
Thank you, Eric. Good suggestion. So let us keep going. For the trailing 1 year period, our average net return, again, this net of any kind of fees or costs or expenses, was 29.8%. The Dow was up 9.6%. So that was approximately 3 times. So that's, again, about triple what the Dow did over the 12-month period.
For the trailing 3 years, our average return was actually 23.3%, which exceeded the Dow by 5 points. Our 5-year trailing return, that is actually up to 18.3% per year, which is over 7 points better than the Dow. And our 81-month track record is at 17.1% per year, which is over 7 points better than the Dow.
Again, calling my second time out. Are all the performance numbers that you just gave in this 10-page summary that you handed to me, are they all real?
They are there and for your viewing pleasure. That same 10-page summary that we gave you, Eric, they're on our website, theorganizedinvestor.com, again, for your pleasure. It's called the Track Record Update. We had to name the baby. And if that's not nerdy enough, we even have more boring documentation at our office if someone wants to come by and really be nerded out.
Well, fortunately, guys, I'm not that nerdy. I'm good to go with this 10 pages. And I will say you're the only financial coach that has told me their actual rates of return. You're actually explaining it on the radio, which gives investors options, right? So Megan, Jerry, they've explained what they've accomplished in terms of improving financial lives for their clients. And when we come back, they'll be explaining what improving someone's financial life really means with what they've done. I'm Erik Ainge, and this is the Organized Investor Show on News Talk 98.7. Welcome back to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. I'm Erik Ainge, host of the Erik Ainge Show on the Sports Animal, weekdays 9 to noon. And if you've just joined us, Megan and Jerry just shared how much they've been able to improve the financial lives of their clients. Guys, for the first 9 months through September 2025, their average net rate of return was 33.2%. It's 3.5 times more than the Dow Jones average in the same time period. 5-year track record, right? Putting their money where their mouth is. 5-year track record, 18.3% per year, 7 points higher than the Dow. And even though I don't know what my investments did in the first 8-9 months of September 2025, I know it's nowhere close to 33%.
I would be shocked if it was, Eric, honestly. But thank you. And we have a lot of happy clients, lots of happy campers coming into our office. So let's just take a moment to explain what we mean when we actually talk about materially improving someone's financial life. That's a big, thing to say. So what do you mean by that? Well, on our mini podcasts, we use the example that if you can improve your overall performance by just 2% per year, so say we take $1 million portfolio and we say, let's improve it by 2% per year, you're going to realize an additional $20,000 per year off of that 2% goal, which is equal to about $400,000 over a 20-year period. I don't know about you, but I could do a lot with $400,000. Erik, does that sound like a material improvement to you?
I'd actually say that's an understatement. If you're looking at it from a percentage standpoint, I mean, duh. Now, that amount wouldn't do much for Warren Buffett, but I understand your point, and getting that example of someone with $1 million.
True. And keep in mind that most people actually have returns that are less than the Dow Jones Industrial Average. So, if you're generous and let's just say you used the Dow Jones Industrial Average as somebody's baseline. That's where their starting point is. Our actual track record has still exceeded that 2% goal for every time period that we went through.
All right, well, what's so magic about 2%? Where's the 2% come from?
Actually, we just made it up.
Wait, actually?
Actually, that's true.
Yes, actually, we just made it up. So we had to start somewhere, right? And that may sound really strange, but literally, we just made it up, which is fine. The point is that even with a meager little 2% improvement, it can make a dramatic change over a long period of time. It's really not about the actual percentage. It's just about having a goal and coming up with that, that improvement.
Being able to do it.
Correct.
Okay, in the locker room, we like to use X's and O's, chalkboard, chalk talk. Explain to us how you all organize their investments. And feel free to simplify it for, me.
Well, here's our little one-sentence elevator speech, which, that 2% improvement comes down from, okay? 1% is expected from lower fees and costs. The other 1% from better performance by being more selective with your investments. Now, all that seems a little bit vague, doesn't it? But we had to cram all that into one sentence, or at least we tried to. But to put it another way, there are fees that may be too high, like advisory fees. There are costs that may be able to be avoided completely, just altogether. And then the actual investment performance may be improved by being simply more selective with where you're putting this money. So again, reduce fees, costs, and improve performance. That's how we get to 2%.
Well, so when you talk fees, are you referring to something that like my investment firm might be charging me, someone listening right now? Because there's a lot of people out there being charged something called an advisory fee based on the size of the account.
That's spot on. That is exactly what we're talking about. And let me say, we also use advisory fees, but the advisory fee that we charge is usually, it's about 0.25% less than what most advisors are going to charge. Now, for anybody, let's just say this, for anybody that considers Charles Schwab as an example to be so economical, our advisory fee is actually less than theirs. They have advisory accounts too, we're less than them. So in our level of performance, we could actually, with the level of performance that we have for our clients that we went through, we could literally double what we charge our clients and they would still be happy. Now, we don't do that because Megan and I just prescribe or subscribe to that do unto others mantra with our clients.
Well, that's something you don't hear very often. It's refreshing. All right, you said something about either reducing fees, avoiding costs. Again, I'm asking questions. Hopefully, these people, everyone listening, is thinking too. Is that the same thing as a fee, reducing and avoiding costs?
Well, and thank you for asking the questions because I know there are probably listeners out there that are wondering the same thing that you are asking about. So the advisory fee is actually what the firm is charging you based upon the account value. And, that's how the advisor or the financial coach is actually being compensated. It also covers some of the costs associated with making trades or, performance reports. There's a list of things that it could actually cover. When we refer to costs, those are the internal expenses that are actually buried inside a lot of the investments that you probably don't even know are there. For example, we actually try to avoid mutual funds, exchange traded funds, and even alternative investments because they can actually add another whole layer of internal expenses that can be even more than the 1% per year.
All right, again, so just to be clear, that an advisory fee is based on the account value, and then there's costs within the actual investments, like you mentioned, mutual funds, exchange-traded funds, on top of all that I probably don't even see. So, how do you pay attention to where you're not getting nickel and dime to death?
Exactly. And a lot of people are not paying attention to that at all, which is why we're pointing that out. So even small percentages multiplied times larger amounts of dollars over long periods of time, that's going to add up to a lot of money.
It can be a lot of money.
Yeah, that's why you need to be paying attention to that.
Exactly. And we look at it as a much better option is to use higher quality individual stocks, pure common stocks with a history of raising their dividends, okay? Now, compared to mutual funds, there's no internal cost to own these stocks. I mean, they're more transparent, so you know exactly what you own, and you can be much more selective with what you own. Now, but to be clear, saving 1% in fees and costs. All that's going to depend on how you're currently invested. And basically, you're either going to realize those savings or you will not.
So if reducing fees and costs are the first two pieces of the puzzle, what's the third leg? What's the next part to get to that 2% improvement?
So the third part is actually about improving your actual investment performance, which is what most people pay attention to, right? Now, this is not as predictable as fees and costs, but it offers a tremendous amount of opportunity. And that's because mutual funds, exchange traded funds, and even alternative investments may actually have mediocre returns, but it's usually what people are all in.
So how is that possible then? Because it seems like I hear financial advisors talk all the time suggesting some type of mutual fund or specialty product that, it's going to make you rich.
Now, keep in mind that if you're invested in 20 mutual funds, that own several hundred stocks, that means that each of those are going to probably own 3,000 to 4,000 companies. That's a lot of companies. That many companies actually means that you've gone from diversification to what we like to call diversification.
Dun, dun, dun.
That's our
Whoa.
sound effect there for that word. Because you now effectively are going to own most every stock on the planet. You own the good ones, but you also own a lot of the not so good ones. We're going to cover this in more detail, but for now, fees and costs and performance is where we usually find that 2% improvement we've been talking about.
All right, so Jerry, you charge a smaller fee, you're avoiding the mutual fund costs, and you're not over diversified into thousands of companies. I can get all that, but your returns are dramatically better. So a lot of advisors out there are talking, but you're doing it. And it's a number of different things that I'm hearing from you from other investors. So can you clear it up? How do you keep it simple for us?
Let's simply say we are basically, what we actually do is what a lot of advisors do not do. And that seems kind of like a binary kind of a comment. But first and foremost, we again invest in actual individual common stocks. Most advisors will put you in, say, mutual funds, exchange-traded funds, annuities, alternative investments, things like that. And for stocks, we basically have two different approaches when it comes to those. The core strategy, the one that our go-to, is what are called higher quality companies with a history of raising their dividends. And we call this strategy dividend growth, and these are usually from what's called a DSIP list that was created from Wells Fargo Research. And DSIP stands for Diversified Stock Income Plan, kind of a nerdy little phrase, but we call it DSIP for short.
We'll have a test on that later, on the acronyms here.
Exactly.
This sounds so riveting, I know, to people that are listening.
Hey, making money does.
That's true. Dividend growth is not the most entertaining way to invest money, though, obviously. So, however, this DSIP list, it does have a 30-year track record of 12.8% per year. So it works, which was about 1% more than the S&P 500 index over that same time period. These stocks are they're the large, well-managed companies like Costco, Home Depot, Walmart, Becton Dickinson, Lowe's, Schmucker's Jelly. These are just a few that I can name. And you've probably, as a listener, been in maybe a couple of these or used some of these products just this week. I know I have. Some of these companies actually have raised their dividends every year for over 60 years. Lowe's included in that, which I didn't even know Lowe's had been around for 60 years, but they're one of them. And that actually indicates that they are very well-managed companies, which is one reason why they are generally less volatile than many of the other parts of the stock market.
Well, I can tell you this. I love the fact that you're makes me comfortable almost. Every single company that you just named, I either shop at or I do use products from those different companies. So these are the type of companies that y'all are investing in?
They are, and that's the core strategy. But keep in mind, this is just one of the two strategies that we use when it comes to common stocks. Now, and with this one, much of the time the accounts may have, let's just say, 2% invested in around 49 or 50 of these dividend growth stocks like the ones we just mentioned. And again, these are core holdings that provide a very nice dividend that's constantly increasing, as well as a lot of price appreciation on top of that.
Now you got Megan Hubbard, you got Jerry Goodman, Tennessee Wealth Management, explaining how they've helped clients materially improve their financial lives. Stay with us. That was the first core strategy because we're going to talk about the second investment strategy that they use to help reach that 2% goal. I'm Erik Ainge, and this is the Organized Investor Show on News Talk 98.7. Welcome back to the Organized Investor Show with Jerry Goodman and Megan Hubbard with Tennessee Wealth Management. I'm Erik Ainge, Ainge, like to call me, right there. 99.1 The Sports Animal, weekdays 9 to noon. If you've just joined us, Megan and Jerry are sharing how much they've been able to improve the financial lives of their clients with the goal of improving overall performance by at least 2% a year. For the first 9 months through September 2025, their average net rate of return was 33.2%. That's 3.5 times more than the Dow Jones average. And they've done this with lower than average advisory fees, avoiding investment costs such as mutual funds, and by using higher quality common stocks instead of mutual funds and exchange traded funds. I can gather all that. One of the approaches is with common stocks, investing in companies with a history of raising their dividends. And they just told us the first core strategy. Let's hear the second one, guys.
So, Erik, here's what we're doing. We are using actual common stocks to invest in what we refer to as bargain opportunities that occasionally occur in the market. We named these bargain opportunities because they are usually triggered by some sort of like a random event that can send shock waves through the market and which are generally temporary in duration. And we'll talk a little more about those, but things like COVID or tariffs. When these bargain opportunities come knocking on the door, you actually need to be paying attention and be able and willing to take advantage of them.
It kind of sounds like we got the old Kmart blue light special, aisle 6, want flashing lights.
Attention shoppers.
Are you going to give us some examples of these bargain opportunities?
Absolutely. And I was thinking about rephrasing this and calling them an acronym BOs, but I thought that didn't sound good.
I'm failing the test now. That's a lot of acronyms.
That's right. Yeah. BO doesn't pass a sniff test. So anyway, our first one, bargain opportunity. Spring of 2020, we moved a lot of money from these boring dividend growth stocks that had not dropped much in price into companies that, as you may recall back in that time, were affected by COVID. Now, these were companies that had dropped a lot in price. So instead of having, let's say, 2% in all of these dividend growth stocks, we reduced the holdings down to about 1% of those same 49 companies that were already in the account. And we reinvested the other piece of the money, into 1%, into 49 of these companies that had been affected by COVID. Now, the list, as you might imagine, it was anything hospitality related, like hotels, restaurants, casinos, airlines, cruise lines, aerospace, credit card companies, anything like that. And basically, we're basically giving you a 50,000-foot overview of what happened during all of this.
So we purchased, virtually anything that was travel or hospitality, like he said, and that had actually dropped significantly in price in the spring of 2020. And at this point, the account effectively had about 1% invested in 98 different companies. Now, as long as, there weren't a lot of bankruptcies among those, and there actually were none, this was actually going to be very profitable investment-wise, and it ended up being a really good idea.
It was so much fun.
How about that? The Organized Investor Show. We're giving some good news that came out of the COVID pandemic. I guess it wasn't so good for whoever sold those.
Yeah.
Good
in 2020.
Point. But see, we're not really we're here to worry about our own clients, not everyone else.
That's fair.
Exactly. So, bargain opportunity number 2. This is when we moved a portion of the money in these accounts into 13 regional banks back in 2023, just a couple of years ago, due to several banks that had literally gone out of business because interest rates had risen. So this was not on the same scale as the COVID opportunity, but it was still, for the money involved, it was still very profitable for the amount of money that we had involved in that.
And then we have bargain opportunity number 3, which is actually related to focusing on some of the tariff affected parts of the market, which occurred, just this year back in the spring. This past spring, we had a lot of available cash, as well as a number of dividend growth stocks that had not dropped much in price. So what we did was we moved all of those funds into these undervalued areas. And, as you're digesting this, part of what makes our process so different and our performance so much better is that we actually have the ability to manage these accounts on a discretionary basis, which gives us the flexibility to make changes very quickly without having to call each individual client.
No, y'all are watching it like I watch a football game. The 2 D tackles are hurt. Well, let's run the football right where those guys are out, and let's go score a touchdown. And I remember the market was in a big panic for a while everyone was worried about the tariffs, how it might cause inflation, maybe put the economy in a recession, the usual uncertainties that scare people out of the stock market.
Exactly. I mean, that is exactly what happened. And since tariff has been discussed for months leading up to that, you can actually see this coming like a mile down the road. So on April 3rd, we executed a total of, and I actually wrote this down, 12,521 trades on a single day. And that was really all within just a day or two of the low back in April. So since then, we've been able to continue to make adjustments, trying to make sure we're being very selective where all this money is invested. And that is exactly why the actual performance, we're up like 33% for the first 9 months of this year, and how that's basically 3.5 times more than the Dow Jones Industrial Average.
So, Erik, these are just, 3 examples of bargain opportunities that will periodically and unexpectedly occur in the market. Obviously, we don't know when these opportunities are coming. The next one's going to be different than the other 3. Once these temporary opportunities are over and done with, because hopefully things like COVID don't last forever, we'll usually migrate back to our core strategy or maybe just move into high-yielding money market funds. Being able to be very selective and manage these accounts on a discretionary basis without, the transaction charges is what makes these returns actually possible. Compared to mutual funds and ETFs, stocks are almost more transparent and they give you better control over the taxes.
They really do. And Megan's comment about taxes, it's a really big deal because with funds, you really have no control over what the fund's going to do. If they declare a capital gain at year end, all that's going to flow down to your tax return and you have no control over it. But with stocks, you can actually be selective in terms of tax planning, even hold shares until they become long-term capital gains, all of which may help you save some taxes. And that's one reason why we love them.
All right, well, I know I'm not capable of doing this. I am capable of understanding it. If you're like me and anyone listening right now, what if you don't know what your 5-year track record's been and you want to compare? How do you compare the performance of their returns to like what your clients have?
Well, okay. So if you're someone who never opens their mail, for starters, I'd actually suggest looking at the statements that you send, not just like tossing those in a pile or shredding them. Actually open them up and look at them. Or maybe you look at them, online because the performance numbers may be shown there. So get online and do some digging. Now, if that doesn't work, I want you to try this. If you assume our 5-year track record of 18.3% per year, and if you ignore the income taxes on that, in 5 years, $1 million investment is going to grow to be about $2.3 million. So in other words, it would more than double in 5 years. That's another way that you can think about this.
Well, it helps because I know for a fact my investments don't come close to doubling in the last 5 years. No way.
And Erik, that's really the point of that. If you don't know, here's a good way to compare it. What your returns have been, giving some type of comparison, compared to what we've been able to accomplish for our clients.
All right. Well, I mean, all this sounds good, right? I mean, it sounds so easy by having y'all do it. Hopefully the listeners out there look at your own mail. It might suggest to help you pay a little bit of attention to where the money's invested, how it's doing, and how you're doing.
That's so true. And another thing is if someone has a 401k plan that's still at their former employer or an IRA they're not happy with, those types of accounts are usually transferable without any tax consequences. And we can just manage them the same way we've been describing here.
So, Erik, before we go any further, let's burn another time out, and I want to cover something because when you first introduced us, you said that we can help people organize those 3 things: their investments, their retirement, and their affairs, which we can. Okay, that's what you kind of introduced us as.
So I'm assuming we're about to talk about all 3.
Well, we'll eventually get to all of them, but some of it's going to be maybe even on a different episode for this show. But for the moment, we're mainly focusing on the investments. Should people plan for retirement? Should they do a cash flow analysis? Do they have enough money for retirement? Sure. Do they need to get their affairs in order with a will or a power of attorney? All that's important, okay? But this investment situation, that is the only thing that can materially improve your financial future, okay? Having a will, doing financial cash flow analysis, all really good and important. But this increasing someone's financial future, improving it, is really how they're going to be able to retire sooner, be able to leave more money to their kid, maybe take a bigger, better trip, that sort of thing.
Well, guys, I'm not planning on retiring next week, and I'm definitely not planning on dying anytime soon, but I do realize the sooner my investments are headed in the right direction, then the better off my family's going to be down the road. And it's just like in football. There's a lot of things you got to focus on for a football game, and some are a heck of a lot more important than others. We're going to take a quick break, and when we return, I'm going to ask Megan and Jerry to explain what listeners need to do, what you need to be focused on to get organized with your investments. I'm Erik Ainge, and this is the Organized Investor Show on News Talk 98.7. Welcome back to the Organized Investor Show with Jerry Goodman and Megan Hubbard from Tennessee Wealth Management. This is Erik Ainge, host of the Erik Ainge Show on the Sports Animal, 99.1 weekdays 9 to noon. If you just joined us, we're having a chat today about how this team has materially improved the long-term financial lives of their many clients. This year, to date, performance through September 2025, it's up 33.2%, which is 3.5 times the Dow Jones Industrial Average. Their 5-year performance is 18.3%. And a performance summary for all 210 accounts. This is posted on their website, theorganizedinvestor.com. All right there. Super easy to see, super easy to follow. And they've accomplished this by charging lower fees. I'm learning avoiding mutual funds and exchange traded funds and instead using these two strategies with higher quality common stocks. It's a relief to actually understand what their approach is and how they're working.
It is glad it makes sense because it's taken us a long time. It's taken us many years to not only figure out how to do this, for hundreds of clients, but also how to explain it to people. And we're always looking for ways to try to do that. I've been in this profession for like 43 years. And I say to people jokingly, it's the happiest 5 years of my life. But anyway, I was also the manager of the Wells Fargo office here in Knoxville. And with everybody that I know, that I've dealt with, that I've seen, I think of the many people out there that are really having trouble finding an advisor who either has the expertise or will take the time to manage a portfolio this way.
So, Erik, what my dad is describing is so true. When we review the statements that people send to us, most of the time it's invested into 15 or 20 things like, either mutual funds or exchange traded funds, or maybe even alternative investments. And even more outrageously is that many advisors even delegate those investment decisions or selections to another part of their firm. They're not even making them. So in a sense, they're actually nothing more than a glorified salesperson being paid to talk you into doing things.
So you're looking at it from the inside out, and you're telling us things I personally have never heard from an advisor before.
Well, exactly. And in addition to explaining what we've done, and why we've done it that way, here's a couple of examples of, say, commonly used strategies that we try to avoid, let's put it that way, because they have higher costs. Plus, they have those, what we call mediocre returns.
And for the first one, on the investments page of our website, there's actually a summary of a mutual fund advisory program called Fund Source. Not fun, like you're having fun, but Fund Source. And it's dated June 30th, 2025. And on page 5, it actually shows their performance of 9.85% for the past 5 years. Now, if you assume a 1% advisory fee was charged, the 5-year net rate of return is now down to 8.85%. So our 5-year net rate of return has actually been 18.3% per year, which is more than double that. And part of the difference is because there's a 0.78% internal cost shown on page 7.
All right. So if you're me and you invested in that type of mutual fund advisory account, you're telling me I'm here and I probably wouldn't be happy with it. What does the 0.78% cost number mean to me?
Well, since you ask, to make the math kind of simple, let's put it this way. You put $1 million in that mutual fund program, that model that Megan just mentioned. The internal cost, basically, of those 15 to 20 funds would be 0.78%, means it's $7,800 per year. So we like to extrapolate things out. That's equivalent to $156,000 over a 20-year period. And that's the cost in addition to the advisory fee that you're also being charged. Now, if you compare that example of 8.85% over the last 5 years, again, to our 18.3% return, you kind of figure out that's what mediocre performance looks like.
And to explain the enormity of this, so according to the investment company Institute, the value of all the mutual funds and ETFs is actually in excess of $30 trillion. That is a lot of money. How much of that is actually invested within an advisory account with a fee is actually unknown. But if you consider different versions of these, mutual fund advisory accounts spread across every investment firm in the country, that's a huge sum of money. And the most common traits are actually the high costs and mediocre performance when we're talking about the situation with these mutual fund advisory accounts.
So, a lot of financial coaches are recommending it. It doesn't sound like the best idea on the planet to me, to be honest. So what else are you going to tell me that my advisor's not telling me?
Well, the second example, Erik, is something that we also try to avoid: alternative investments. And I hate to use an example, but I will. Blackstone Real Estate Trust, okay? Good company, well-respected operation. But We also have a copy of a summary from their their portfolio on our website, and it shows that as of June 30th of 2025, their 5-year track record of that Blackstone investment was 10.4%. So again, if you assume, say, a 1% advisory fee is deducted from that, their net return would now be down to 9.4.
And, this is not terrible performance, but comparison again, to our 5-year net rate of return, which I told you is 18.3%, that's almost twice as much. And keep in mind that alternative investments can actually have higher costs than even mutual funds. Blackstone may take up to 5 years to completely withdraw the funds, which makes it rather illiquid. So if you need your money fast, you're not going to probably be able to get it. And it can actually, make your tax return even more complicated, which may increase the CPA fee. Nobody wants that. Basically, advisors like to refer to Blackstone as a private equity investment, as if that's, a guarantee of some fabulous return, which actually hasn't been the case.
All right, I'm listening to this, and one of the things you guys said earlier is people don't fire their financial coach, right? As you're sitting there, are you criticizing them? Like, how would you expect someone listening? Well, my advisor's a great guy, right? Or we're best friends. Or like, what do you say to the person listening? It's like, hold on, I feel like they're attacking my advisor right now.
And I totally get that, right? Like, we have relationships with people that we're close to, and we think highly of. In terms of them, being a great guy or maybe even a great girl, because there are financial advisors out there that are women. So I'm sure that they probably are. That's what I'm going to say about it. They are probably wonderful people, and we are not trying to bash them, but we are talking about your financial future here. And, it's not a personality contest. This is your money. We're explaining a process that for some is going to have potential long-term benefits that's actually going to total in the hundreds of thousands of dollars. And on average, we're up to 33% year to date. So what is 1/3 of the value of your portfolio? And with all due respect to the financial coach that you might have, if you are hoping that they're ever going to offer these same pieces of advice and suggestions that we're giving you now would probably be a good time to lower those expectations.
Love it.
Performance and numbers don't lie. I mean, that's we do all know that. So if you're out there listening, how does someone know how much this might benefit them? What should they do next?
Well, Eric, as you ponder what we're explaining, the potential benefit is going to depend really for anybody on how their investments are currently being managed and if there's room for improvement. So we're happy to review somebody's situation. We'll give them a no-cost, no-obligation summary of what the benefits may be. Now, to do that, you can upload a recent statement, a copy of your statement to us. We have a secure upload link on the investments page of our website. Again, it's theorganizedinvestor.com. Or you can mail them to us, drop them by, come by the office for a face-to-face chat. But either way, having a discussion with us is really a good first step. Then we'll let you know, what we see and what we feel like you might be able to accomplish.
So our very favorite part of this show, is explaining that the returns for each of our clients' accounts can vary based on the client's individual circumstances, because that is true. Such as, when they started their account, what their investments might be, their objectives or their goals. Everybody's going to be different, okay? So we have to make sure that people understand that. Also, we have to make sure that you understand that the rates of returns for our advisory clients were compiled from a month-end performance report for each of the 210 accounts that we respectively manage. And we have a lot of boring documentation to back up these statistics. If you're interested, or maybe you need a sleep aid, I don't know, call me and I'll provide that for you. You're invited to listen to other episodes of our podcast on our website, theorganizedinvestor.com, or on your favorite platform that you might listen to your podcast on by searching for The Organized Investor. Be sure to follow us on social media, such as your YouTube channel or LinkedIn, X. Save us to your favorite podcast player, and you'll want to receive those reminders of future episodes so that we can make sure you are up to date with what we're sharing.
Oh, Megan, you absolutely killed the disclaimers right there. All right, guys, this is Erik Ainge with Megan Hubbard and Jerry Goodman. This is our first episode together of the Organized Investor Show on News Talk 98.7. I hope you'll join us every Saturday at 11 a.m., Sunday at 9 a.m. for more ideas on how to become an organized investor. You can also find these shows, like Megan said, on their website, theorganizedinvestor.com, your favorite podcast podcast platform or right there on the podcast page of The Erik Ainge Show. You're invited to chat with the team, discuss your situation, and see if working together might be a good fit. Those numbers sound pretty darn good to me. Thank you for joining us on The Organized Investor. We hope you'll join us for the future shows and help organize your investments, your retirement, and your affairs.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or TN Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. The Organized Investor cannot accept trade or account instructions on or through this platform. Please contact us directly at contactus@tnwealthmanagement.com or 865-415-2060 to place a trade or for trade or account-related questions. Brokerage and advisory services are provided by TN Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by TN Wealth Management for educational platform purposes.